Hi everyone, today we have Radhika Gupta, who is the MD and CEO for Edelweiss AMC. Hi Radhika, welcome to the second session of EquiTalks. This is where what we intend to do is get wise people like yourself to clear the air in dynamic markets like these, volatile markets like this, and help our investors navigate through tough times. So obviously Radhika needs no introduction. I think she is the most powerful woman in the asset management and the financial management space. So without spending too much more time, I will just get on to the discussion. So Radhika, obviously a lot has been happening in the Chinese markets, in the US markets, crypto market, rates moving up, lot of news. Russia is playing its own story. So where do you see and how would you advise a young guy who would have entered the markets maybe only in the bulls phase last 3, 4, 5 years? How should how should the investor deal with the current situation?
Okay, so thank you for having me, firstly. And before I go to the macro bit, and I am happy to answer that, I think the last couple of months, have probably been a source of anxiety to a lot of young investors, especially, or investors, old or young, who have entered the markets, as you said, in the last 18 months to 2 years. And a lot of them ask me questions like, ma'am, why is the market falling every day? And to which my answer is, why are you looking at it every day?
Yeah.
Because truly the volatility that you're talking about, now while some events are common, some events are expected, some events are unprecedented, and we can talk about that. The fact is that volatility in the markets is not, it doesn't mean markets are broken. It's, as I say in computer science lingo, it is a feature of the markets. It's not a bug. It's not like markets malfunctioned. It's just that you're seeing it after 2 years, so it feels a little more stressful. Our belief from a macro point of view is that, in fact, we said this sometime in November, December, we put out a note that the first half of this calendar year is going to be an extraordinarily volatile one. Now, one did not bargain for such geopolitical tension. But of course, the impact of rising rates, I think for 2 years the world has been in a zero interest rate regime. And when rates are zero, a lot of good things happen to equities, private markets, IPOs, etc., etc. And some of that is unwinding, and it is natural course. So I think the first half of the year will be volatile. Our learning also is that finally we are investors in funds and companies. And company prices track their earnings. And we do believe, especially in the second half of the year, that as long as earnings remain robust, volatility will start to normalize. But, I would repeat what I said. What you're seeing in 2022 is a feature of equity investing. It's not a bug.
Okay, great. So Radhika, I think both of us started our career in that just near the GFC regime. A lot of people are contemplating whether this is as close to GFC or will this come as close to it. So what's your thought on that, per se?
I don't compare crises. I don't feel, it feels like GFC, by the way. I remember being a young analyst. I started around 2005, and GFC was something of serious scale. I think in the post-GFC era, both central banks and institutions are much better prepared to deal with events like this. And every crisis is different and yet a little bit the same. There is, I would say, from an investor point of view, this is a world where there's a lot more noise in social media, even from the GFC era. So that aspect feels different. But I do think central banks in the world at large is more prepared to deal with things like this than we were during GFC. So I think the world does get more resilient and robust, but I don't compare crises.
Okay. So also with the rising interest rate and with the inflation touching like multi-decade highs for a lot of countries, India is I think 7-8 year high as far as the retail inflation number is concerned. Interest rates obviously on the secondary markets have moved up. Primary RBI increased it by whatever 40 basis points couple of weeks back. So how should a retail investor play out his debt portfolio?
Okay. I think we tend to overcomplicate debt. Um, you know, and while I come from the mutual fund industry, I think the banking industry sometimes simplifies it a little bit better, because they have a notion of a savings bank account and they have a notion of deposits. And the whole day, when you after you do an FD, you don't sit and stress over, oh, RBI did this and X did this and crude happened and inflation happened, और मैंने जो 6 महीने पहले FD बुक की थी उसका क्या होगा, right? And I think you have to learn a little bit from that framework as an investor. Keep things very simple. Have contingency money, and that should be parked in very short duration and savings type of instruments. Equivalents in mutual fund are things like liquid funds, arbitrage funds. Essentially, you are not taking duration risk. And honestly, if you're getting lower or higher returns there, accept it, because that's just market.
Yeah.
Okay? And then have a book of what I call the FD like money. My favorite debt product, and I am of course biased, is the whole category of passive debt funds, debt index funds. These are target maturity funds. It started with Bharat Bond and now there are lots of them. But essentially they have a defined maturity. You know the yield you're getting, that's good quality paper, and you pick whether you want to do 2025 or 2030 or 2032. You pick your ladder and you invest. And then once you've invested, don't stress. In fact, for new investors or investors who are still looking to invest, the higher rates will actually pose opportunities, just like you get very happy when your FD rates are higher. And the third thing I would tell investors is, don't try to do cute things around credit and stretch the boundaries of a 1% YTM and 2% YTM. That's usually when things go wrong in fixed income. You're better off taking that risk in equity.
Fair point. So also what has started happening, Radhika, and obviously you are one of them who has obviously pushed that category a lot in the last 2, 3, 4 years, because interest rates had come down and pure play debt funds were not yielding more than 4.5%, 5% good quality debt. Balanced advantage as a category came up, right? Yeah. And for whatever research that we do on a day-to-day basis, Edel runs a BAF fund, which is very, very different from what others do. If you can throw some light on that, what is the strategy, how it can benefit, and if somebody has to diversify between BAFs, how an Edel BAF will be very different from, say, any other?
So BAFs are my favorite category of fund. This is something I've talked about a lot, because, and I will come to Edelweiss BAF, because I think they meet the need of most investors, which is meaningful absolute return with some downside protection when it really counts. The Edelweiss approach is different. Essentially, I would liken it to driving on a road, which is that if I'm driving from Bombay to Pune and the roads are wonderful and the weather is clear, then I will pick up speed. Because the road health is good. But if it's a really rainy day and the roads are terrible, I will take down speed. That's essentially what we are doing. We are looking at trends in the market. If markets are healthy, if they continue to rally, if they are not volatile, equity exposure will be high. If markets are the opposite, equity exposure will be low, and it's driven by a model called the Edelweiss Equity Health Indicator. So it is a different approach to BAFs. The traditional approach to BAFs is to look at metrics like price to earnings ratio, etc. We believe the reason for following this approach is we believe markets move in broad trends. You will earn 10-12% in markets year on year, I mean over a long term, but it will not be year on year. There will be plus 30, minus 30. So we want to capture those trends. And I think so far Edelweiss has been able to do that successfully. In the big up years, it captures the upside. In a period like March 20, where markets fell 30% in a month, it was probably one of the best performers, if not the best in the category. I think as far as diversifying BAFs, I'm a big believer in diversification. And I always tell investors, if you want to diversify across 2 different styles. There's no point picking 3 schemes that all follow the same investing style. So if you want to diversify among BAFs, pick one of the BAFs that does price to earnings, etc., etc., and pick one trend following BAF.
I think fair point, because I also hold a significant part in BAFs. As far as my personal portfolio, Edel BAF is again a very strong product and philosophy, and very different from what others do. Coming to diversification, obviously there are another two asset classes apart from the BAU ones, which is one is alternates, which is coming up like a tiger in the last 6-7 years, and obviously gold, which has been there for multi decades, right? So how should an investor both in the retail and the HNI space look at these two categories from his or her portfolio perspective?
So I think gold is a retail plus HNI product. It can be used as a diversification tool. I always tell investors, can they have 5 to 10% in gold? Perhaps, it's a period of rising inflation. It's a hedge against that. I don't think investors do a great job of timing their entry and exit into gold. So I think a static allocation is probably better. As far as alternatives, this is clearly an HNI product. I don't think this is meant to be a retail product. And I come from the alternatives world. I think the scope and space in alternatives is very vast. You have everything from private debt products to long short, more hedge fund kind of products, to products like we're launching a fund that is around the unlisted space and mid-stage, private equity. So there is a very wide range of products. I think some of these, the alternatives platform is far more flexible in terms of what SEBI allows you to do with it. But it's of course very important to understand why you are picking an alternative product and what you are going to get out of this, because these are higher ticket size products, often locked in products. So it's just important to understand. But of course, it's a fast growing space.
Obviously, there is a big difference in which the late 30s or early 40 investors are investing, and how the early 20s guys are investing these days. With technology, obviously, investing has become far more simpler. How do you see the millennials investing, and how is that going to have an impact as far as Indian economy or Indian markets are concerned?
Okay, so technically I think I'm still a millennial, even though I'm nowhere near early 20s, but I checked the definition, I think I'm still a millennial. Look, I think one, investing has become accessible to everyone. So in terms of doing transactions, I think whether you're 50 or whether you're 20, it's become more accessible, and that is a good thing. The days of those big forms and filling out SIP registers. So I think investing is accessible, it's accessible to the length and breadth of India, and that is fantastic. As far as younger investors, obviously, I often say that the 20s is a generation that is far more financially aware than perhaps my generation was, and certainly much more than my father's was. And as my father says, they are a generation that's growing up in an aspirational India, not an India of scarcity. Yeah. So it is very different. So they want more with their money. They're not content to park it in a fixed deposit. They have the resources to understand money. There's so much content out there, and it's of course easy to transact. These are all very good things, and I think at a macro level, this will help. This movement towards financialization is very good for India. It will contribute to larger domestic investment. It will contribute to a bigger SIP book, the impact of which we are seeing. Stability of capital markets, all of that is good. Of course, it's a younger generation, so perhaps it's a little more impatient. It's open to newer themes. So, whether it is cryptos or whether it is international ideas or buying US stocks, I mean, people are really open to everything. That has an upside. It also has a downside because you have to be very thoughtful. Finally, money is hard earned, and I think you have to be very thoughtful. So whenever I talk to young people, I tell them to be very careful in where they want to invest. Investing is finally a boring thing.
So Radhika, you were on the word of SIP, right? And obviously we are seeing 11,500, 12,000 crores of SIP, which are, in my mind, probably saving the market from really cracking down. What is the real reason for such SIP? Is it the ease to doing, as you said, no more those large forms, or is it because the interest rates are over on a lower side? What is making the Indian believe that, okay, SIP is a great way of making or saving money, I would say?
I think SIP is a habit that works really conveniently. Like, And the beautiful thing about, and so I don't believe people do SIPs for returns. I believe that people do SIPs because we are all, most of us are salaried professionals, right? And we often don't have large amounts of money to deploy in one go. But that little habit now, which you in childhood was putting money in a gullak, etc., of just saving constantly, an SIP is that, and so it allows you to save and save in a small way. My driver, for instance, started an SIP into our own balanced advantage fund, and from his salary, there's a small amount, 1,000, 2,000 rupees that he puts in every month. And the beautiful thing about SIPs is, before you know it, this small habit actually translates into a meaningful amount of money. And I'm a salaried professional, I do a certain amount of SIPs, and in fact I have a target in my head that X amount of my post-tax income should be SIPs. The other good thing is, I think if you look at SIPs, and most people don't realize this, is that returns are reasonably consistent, because SIPs insulate you from market volatility. So this question of market का क्या लगता है, अभी invest करूँ, बाद में invest करूँ, when should I do this, that goes away with the SIP. Markets fall, you collect more units, it averages out the whole market performance. So I think the SIP is probably the best thing in some sense our industry came up with, because it's a small habit that is meant very well, that works very well for a salaried Indian.
Okay. So obviously no discussion can be over without understanding your personal, because you said that one part of your salary goes, or post-tax salary goes, into SIPs. So how does Radhika Gupta's portfolio look like? Not only on the equity side, but also from an overall perspective.
It's actually very simple. My husband also is in the capital markets profession. So one, you should know that our income can be very volatile, and because both of us are senior, it also happens to be in stock options sometimes. So good years for capital markets often tend to be very good years for us, and bad years tend to be not so good, so we do SIPs. We are big believers. We target a significant amount of our post-tax income as savings into SIPs, and then annual bonuses, etc., also get allocated. We are also conservative investors, so usually about 60 to 65% goes into BAFs, which we spoke about. That works well for us. We also do SIPs into mid and small cap funds. This is to add a little bit of alpha, and we also do some amount into international funds. Because my husband's in the alternative business, we also have some investments, a small part of the portfolio, into alternative funds. We do not hold a single stock except the company that I work for by way of ESOP. So we have never, people will be surprised to know that neither of us in our entire career has ever held a stock. We've only invested through funds. So we are great believers in the profession that we represent, and yeah, we don't do unlisted, illiquid asset classes outside of maybe an unlisted fund that we launch. So outside of a primary home, we don't have real estate, etc. So we are fund people through and through.
So one small advice that you would want to give to young, I would not say young, but people who have just started maybe savings, or their salaries would have come to a point where disposable income is there and they can still save significant amounts. What is that one advice you will give to them?
I think start the habit of investing. Put down a list of goals, and align your short, medium term goals against different investment buckets that we discussed: BAFs, equity, fixed income. And it doesn't matter what amount you start with. I think the critical thing is to make a start towards this investment habit. And the other thing I would say is, don't worry about making mistakes. Investments is learned by doing. So get started. You'll make a few mistakes. You'll learn what works for you, and then you'll tailor and move forward.
So they say that worst experiences sometimes give you the best learnings, right? So there might be one or two instances in your prolific career where either through markets or some risk that you would have taken, there would have been some experience, would have taught you a lot. So if you could just highlight one or two of them.
I think 2008, I've spoken about this before, but it's worth repeating. I had just started working and in 6 and 7 had put a lot, actually everything into equities without really understanding asset allocation, because we believed we were young and so you could do everything in equities. And the learning my husband and I had is that, the math that if you're 25 do 100% equities and if you're 60 be very conservative, it doesn't work because each person's situation is very unique. Ours is unique, as I said, because we are both in high risk professions, and so when bad times happen they become really, really bad. And so the learning has been that never invest so much in equity that it becomes a source of stress. And since then, we've been a lot more calibrated in our approach. And personal finance has never been a cause of stress, no matter how bad markets get.
Okay, thanks, Radhika. I think before we end this session, we would want to understand maybe one a quote, an investment quote by which you probably live or by which you kind of operate.
Oh, so I'll probably continue from the story I said, is that in the word personal finance, personal comes before finance. And this is something I tell all investors, that there is no right answer. There's a right answer for you. And this is especially relevant today because we are in a social media driven and FOMO driven age where there is a great tendency to copy, and to say, okay, he did this or she did this, so I will do this. And what works for X doesn't work for Y. And it's important to realize that. So I think in personal finance, personal comes before finance.
Yeah. Thank you, Radhika, for this insightful session. I think whatever you have said might help us investors work or navigate their way through their personal finance and also help them understand what's happening right now in the markets and maybe take a more informed decisions. Thank you so much once again for taking out time.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.